Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for February 7th of 2022. Please see our disclaimer for important information. Well, in our high frequency data for the week, we can see that some areas have improved on a month-over-month basis. We're beginning to see a little bit of green here in the week-over-week changes, particularly commercial flights, supply of motor gasoline. We're still down a little bit on checkpoint data. Week-over-week is perhaps a little bit, and also the month-over-month is a little bit seasonal as we exit the holiday season, but if we look at change versus 2019, we're still down about 28%. So we have had some Omicron-related travel curtailments, business travel, again, as these cases spiked during the month of December, and certainly into last month as well, that there was some curbs in activity. OpenTable, the same deal, although we're beginning to see some green shoots there. As the case volume subsides and we get into the throes of 2022. Hotel occupancy, monthly data looks good. Again, weekly data slightly negative, almost flat, if I would call it. But then versus 2019, you can see that first column with all the reds, and so we're still struggling to get back up to that 2019 pre-pandemic level. But again, the bottom line, the takeaway here is that we're seeing some green shoots in some of these areas that have been particularly weak over the last month. Here's some of the individual detail points, just so you can get a frame of reference, kind of more in a more visual way. Hotel occupancy, TSA checkpoint, OpenTable, and retail sales. And you can see on the left-hand side of each of these four graphs, kind of this kind of greenish aqua color, which represents the getting out of the starting blocks here in 2022. And you can also see relative, really, and I'll call it the gray line in each of these cases represents the 2019 level. And so, if you look at hotel occupancy, we're actually not that far behind, but we have come a long way. And you can see that kind of that orange line there represents the shutdown and the recovery, and that gap that was being narrowed. And then the heavier blue line represents 2021. And you can see that in all of these cases that the blue line showed that improvement and got us closer to 2019 levels, except for the case in weekly retail sales, in which we really have outpaced 2019. Consumers have been very strong. Durable goods orders have been exceptionally strong. And we know that service sector activity is picking up at a time where maybe durable goods orders are kind of subsiding a little bit, but we're starting off on a real good basis on retail sales and frankly on OpenTable as well. TSA checkpoint data and hotel occupancy we've already talked about. Quick check-in on U.S. private construction spending, and this is something we've been talking about for a while, that we know that non-residential or commercial construction has been relatively flat. A lot of that has to do with the office market and the uncertainties related to what the future of office looks like. And then on the residential side, we know that builders are very rapidly trying to fulfill this gap and this housing affordability issue that exists out there in the country right now because of a supply-demand imbalance, meaning that there's a lot more demand. Supply is struggling to catch up, but you can see that relative difference there is really almost as strong as it's been in, we'll call it at least a decade and a half. And so you think about all the derivative or the second order impacts for home construction. You've got building materials, all of those things, labor costs are going up for construction, and all of that's having an impact. On the right-hand side, you can see the derivation of that residential construction, and that blue area at the bottom represents essentially new single-family residences, and that's been the bulk of the improvement. Although we have seen a real strong increase in home improvements and a little bit of benefit from multifamily as well. We'll talk a bit now about the labor force, and there was some interesting information out of the Federal Reserve and one of the Federal Reserve districts that I thought was kind of helpful. Kind of points out this whole issue of retirements and people leaving the workforce. And this is actually a chart from Statista on the civilian labor force here in the U.S. And before the pandemic, our civilian workforce was about 164 million, about 157 now, and you can see how that's tracked over time, a gradual growth, kind of in some cases tracking the population growth in the country. Although we know we've got an aging workforce, and at some point these older baby boomers that started to turn 62 back in 2008 are aging out of the workforce. So we know that we're getting retirements from them, and the replacement rate is not very robust. And so that, coupled with the pandemic, you can see at the right-hand side where we've actually taken a step back. And so we're still about 4 million below where we were in terms of labor force activity, meaning individuals in the labor force. Now think about that, 4 million. So at roughly about 2.4 of, I'll call it the 4.2 million that have left the labor force, are what I call excess retirees. And those are folks that for one reason or another, they're working age, but they're just leaving the workforce for whatever the reasons are. So this is from the St. Louis Fed. On the left-hand side, composition of the working age population not in the labor force. Now, let's think about that for a quick second. So this is working age population. These aren't older folks that are retiring. These are people in that below 65 age cohort, and you can see not in the labor force by share of activity. And this just represents that of those of working age not in the labor force, that right now over 50% are retiring. So that's a big reason why people are not in the workforce that could be working in the workforce. And you can see that impact has gone up over time. So it's not a new phenomenon. It took really kind of a reset during the pandemic, but has accelerated since then. And so this is a big reason why a lot of people are leaving the workforce. However, in our latest reading of employment, we got our non-farm payroll number for the month of January last Friday, and we added 467,000 jobs, and that was much, much higher than expected. We have an unemployment rate of 4%, but interestingly enough, we had almost 3.6 million people that were absent at some point during January due to illness, and a lot of those folks had Omicron, and that was actually much higher than the 2 million that were absent due to illness back in January 21, and 1.1 million that were absent in January due to illness back in January of 2020. But in any case, you see people that are leaving the workforce that are just simply retiring and not working, period. On the right-hand side, you have a kind of a longer-term trend, call it, and this is evidence of what's going on with baby boomers. And that dotted line, vertical line, represents that point in 2008 where those baby boomers started to turn 62, which was the first year that they're eligible to take Social Security. And as you can see, retirees in the U.S. population really began to cycle up at that point because of the large concentration of our population comprised of baby boomers. And so, as we get to where we are now, we just have that additional excess retiree layer that's kind of articulated a little bit in the left-hand chart, but that's causing that number to spike actually a little bit higher, than it would have otherwise been had we just been tracking the baby boomer retirements. Retirees as a share of the U.S. Working age population, and again, this is an aggregate number. This is really kind of an overlay of the same data that we were just looking at on the last page. But what's interesting in all of this is the share of new retirees younger than 65. Again, this is what I was talking about. This is working age people that have just simply chosen to kind of check out. And you can see that, there's been this long-standing trend of people working longer because longevity is frankly longer now, and people are living longer, and so they're working longer, and so retirees younger than 65 had been trending down because people, generally are a little bit healthier, live longer, and they can work longer, and they want to. But that changed in the pandemic, and you can see that number is trending back higher. Now, continuing the theme of payrolls and labor, this just shows you what I mentioned a couple slides ago, that we had a much, much better number than we thought we were on payrolls for January. So we added, as I said, 467,000 jobs. There were a lot of analysts worried about the impact of Omicron and worried about the impact of people being out of work, and we actually thought that we were going to lose jobs, perhaps. And so that number was much, much stronger than expected. In fact, the revisions over the last 2 months, and you can see like November and December next to January's 467, and those were revised higher by almost 700,000 jobs. Really, really strong. So there's good and bad in all of this. Obviously, the good is, people are getting back to work and we're adding new jobs. The bad news is, for those watching the inflation picture and those watching what happens to the Federal Reserve and interest rates, this just simply adds fuel to the fire that we're going to get those rate increases that a lot of people think we are. And whether we get 2, 3, 4, or 5 rate increases this year is anybody's guess right now, and no one can say for certain exactly where this is going to go, because I do think that there's a lot in this data that's going to level out, and I do think we're going to get relief in inflation from the supply chain choke points, which I'm about to show you is beginning to ease up somewhat. And so I also mentioned a second ago about absences from work due to illness, i.e. COVID, and that's on the right-hand side in a chart that I pulled off of Wall Street Journal. You can see that number really spike. I mean, uncannily high in January, 3.6 million. And you can see how Omicron has really kind of upset the apple cart here lately. However, that hasn't had an impact on jobs because a lot of people are working remotely, and that's what I'm trying to illustrate on the left-hand side, is that the labor market, by and large, is exceptionally strong despite Omicron, and completely defied, on the positive side, completely defied the analysts' expectations. So now we've got a quick look on average hourly earnings. So, and there's two views of the same data. So the left-hand side goes back really about 5 years, and you can see, this kind of almost flat to slightly rising wage growth, and then the inherent disruptions related to the pandemic, and then where we are now is essentially about 5.7% in wage growth, and obviously that's much higher than we've seen. It's lower than inflation, so real wages actually have gone down, but we all know rather that inflation is abnormally high right now, and so that's kind of a hard statistic. The right-hand side, I simply just go back and show you dating back to prior to the global financial crisis where we were, and you can see that average hourly earnings growth, has trended, really no higher than 4% until we got to the pandemic. In fact, 3.5, 3.6 was about as high as we got, and that was some time ago. And I do think earnings growth will level out at some point, and we'll be at a point where we won't be talking about the surge in potential inflation coming from wages like we are right now. I reposted a Twitter post from Liz Ann Saunders. Productivity is really important because it does help to damper inflation. And here in this post, and in lieu of explaining it, you can just read it here, that productivity was actually very strong, much stronger than expected. 6.6%, that may seem abstract, but that's a pretty high number, and it's well above expectations. It has kind of bounced around a little bit, and then this is overlaid against unit labor costs, which is a loose proxy for average hourly earnings that we just looked at. You can see here that high productivity, which has actually been trending a little bit higher than normal as of late, could help us on the inflation picture, tempering that somewhat. Well, on the flip side, we have gasoline prices, and this impacts consumer sentiment. And you can see that the average price for a gallon of gasoline is about $3.40 on a national basis. You can see how that has trended up in the most recent reading. You can certainly see how it's trended up during 2021. So this is still kind of an anchor on sentiment, because this is the one thing that when you go out and buy something, that it's easy for you to track, because you remember how much you paid the last time you filled up your car, and then when you go fill it up and it's about 15 to 20% more, you do see that, you do feel it, and a lot of people in the lower income cohorts certainly feel it. A quick look on manufacturing. Now, we do know that the manufacturing sector has slowed down a little bit, and particularly in 2021, it kind of rolled over, but still at a fairly elevated level. And again, everything is cyclical here, and we exhibited some cyclical peaks, but we're still growing. I say PMI, Purchasing Manager Index. This is a diffusion index, so anything over 50 means expansion. It just means that we're not growing as fast as we were. Nothing wrong with that. We're still very much in expansion mode. But a couple of things that I think are relevant in the following charts. On the right-hand side, we have prices paid, and inflation, input costs have been a real bee in the bonnet for producers. And these are manufacturing firms dealing with input costs like steel and platinum and in some cases rare earths and lumber and things like that. Here you see that prices are, have maybe bounced up in the latest reading, but they're still well off their peaks. And so this conversation that we were having about 3 to 4 months ago is still valid, because you can see in the aggregate, prices from a survey standpoint are still high. They're just off their peaks. Good sign for certainly for producer prices, and then downstream for consumer prices at some point in the future. Here's supplier deliveries, and these are off their peaks, and then backlog of orders well off their peaks. Now, this is probably as good a slide as I can show you right now about how manufacturing firms are working through their supply chain issues. And so this is kind of like evidence, article of evidence 1 here and 2 that shows you that some of these choke points are now easing. Here is vehicle sales, so another point of evidence that supply chain is beginning to ease up, that we are seeing an uptick in vehicle sales. In fact, this reading here in January, the estimate was for about 13 million units annualized, and we actually got about 15 million units annualized, so much higher than expectation, showing a strong rebound. Again, auto sales were dampened in many respects because of a supply shortage of semiconductors that go into these things, and a lot of stories about cars and trucks being mothballed in baseball and football field parking lots because they were at the last stage of production. They just didn't have the microchips. Well, the fact that we're seeing an uptick in sales, coupled with the two charts that I just showed you on manufacturing, tends to suggest here that some of this issue is working itself through. That's not to say that we're not going to have supply chain choke points in 2022, because I do think that issue persists, but it gets better throughout the year. Here's our US dollar, and I can show you here that the dollar really over the last year has been pretty strong. And as we note that, a lot of the rest of the world is going through some of these same issues. I mean, the volume of negative yielding sovereign debt around the world is just plummeting because interest rates are moving higher around the world. We know that inflation is not a U.S. phenomenon, that is going on elsewhere. And so we're seeing all of these, we're seeing, a lot of these areas around the world exhibit more inflation, higher interest rates. And now that's beginning to take a little bit of, it just took a little bit of froth off the dollar here last week. In fact, it was probably one of the largest moves that we've seen in the better part of the last year. Here is the real yield on the 10-year Treasury. Again, real yield is basically the nominal yield that you can look up in the financial press, what 10-year Treasuries are currently yielding, and then you subtract out inflation. And the fact that we're getting some movement higher in yields, coupled with the fact that we do have high inflation, but real yields are moving much higher, and you can see here that while we're still a negative real yield on the 10-year Treasury, it's getting much closer to break even. Here's a post from Gina Martin Adams as we get into kind of more of a stock and investment discussion, and obviously there's a lot to talk about here on equities and stocks and the stock market because of all the volatility that we've seen. And again, in another case of, I thought it was better just to print the post or cut and paste the post than it was to really kind of describe it. You can read it that basically, we have gone a long way actually to pricing in this Fed tightening cycle. We've talked about this, but the markets are really pricing this in. And so, we've had other instances, and here Gina Martin Adams goes back to 1970, and we've had some meaningful drawdowns ahead of Fed rate increases, or Fed tightening cycles, if you will, i.e. when the Fed begins to raise interest rates finally. And in 2022 we've had kind of a maximum drawdown of 10%, and that's really is larger than anything that we've seen since the 70s. So it was a massive drawdown, which I do think helps to lay the foundation for a reasonable bounce back of some sort once we get past that first rate increase next month. Here's something else, as we continue the stock discussion, I thought was pretty interesting. I think just for perspective's sake, and granted we're in a unique period because we are literally on the eve of a rate tightening cycle, but this just shows you month to month on average what the markets have done over the last 25 years. And suffice it to say, January's usually been a softer month in terms of returns. You can see that in the red here, and the percent of the probability of positive returns really goes up when you get into February, March, and April. And you can see that the average returns for March and April, particularly April, are really high. And you can see that essentially on a quarterly basis, like July is really strong. October, November, and even December are generally pretty strong, but then you usually get like a little bit of softness in January. So notwithstanding the fact that we're heading into this rate tightening cycle, January is usually a pretty soft month anyway. And we got a scatter plot here of corrections, and we just talked about, from Gina Martin Adams, the 10% peak to trough correction that we saw during January. Even though we ended the month off of that low, you can see here that since 1965, this Oxford Economics tracks in the kind of the gray and black areas. They track the average corrections that are not associated with recessions, and then the red dots represent corrections that are associated with recessions. And you can see that the length of days is typically a lot longer, and the drawdown overall is a lot bigger when you have in those red dots that represent when you're in recession. Markets typically correct larger and for longer. But when you're not in recession, generally the drawdowns are pretty light, and that's why you see a cluster there in the upper left-hand side. The average drawdown in a non-recession period, maybe 15%. We've seen well north of 15% drawdown in a lot of stocks that are within the index. But the index itself, maybe not down that far. But the average duration is, maybe 3 months. So, at worst, I think, you can look at this as saying, we're close to the bottom in terms of a correction, and at worst, we've got maybe a couple of months of some churn in the markets before we begin to find our feet. And that ironically would coincide extremely well with this, the passing of the beginning of this rate cycle, when the Fed does raise interest rates next month, and we get into April, and so then it's not unexpected. Then the anxiety is kind of taken out of it, and I do think that this, coupled with what we saw before, what we're about to look at, kind of sets the stage maybe for a rebuilding of equity. I won't call it momentum, but at least positive performance after we pass through this period of volatility. So I thought it was helpful. Again, January, we just saw that January is typically a weaker month in the market. And when we've had corrections in January and the market's gone down, how has it impacted? Well, we just saw on the slide before that non-recessionary corrections can last, 2 to 3 months. And so this is just to say that I am prepared for a little bit more volatility here in February. Again, we're leading up to that rate increase, so it's natural, expected. You can see here going back, and looking at a lot of different periods and what that February return looks like. And it's not unanimous that we're going to have a negative month. That negative 11% in 2009 might scare you, but we were coming off of the global financial crisis. And then you can see here, essentially after March 9th of 2009 is when most of the uptick happened. But you can see the final 11 months in total for 2009 where the market was up 35%. So, I just want to point your attention to, that the middle column, February return, and the final 11 months, that it's not a foregone conclusion that markets are going to be negative, but if they are, it's generally not that much. And if you look out over the final 11 months of the year following a major January drawdown, markets are, by and large, higher, the exception being in 2008, when, again, we were in the middle of the global financial crisis. Well, in looking at, where's the market's head right now, one thing you can look at is, what individual investors are doing, what more informed and intelligent investors are doing. And here we see small trader contracts. So these would be like, I'll call them more informed than the average retail investor. but they've been, and behavioral finance is really, really powerful. And so when the market exhibits volatility, anxiety moves up, what people usually do is they'll go out and buy a bunch of put options, which protect them on the downside. So when you have a real spike in put options being acquired, that means that people are really scared about the market and they're trying to protect themselves. And oftentimes they do it after most of the damage is done. And this is actually a good contrarian indicator that tells you that maybe we're closer to the bottom of all this, because you can see in this chart here, it shows you the massive spike that we've had here lately in options contracts, put options contracts being bought on the open market. And here's something that I thought was pretty interesting. Again, really speaking to what's going on inside the head of the retail investor. This is from JP Morgan, and this is just a survey question. Are you more likely to increase or decrease equity exposure over the coming weeks? And this is the percent that's planning to increase is in that blue line. You can see that it's really moved higher. And so, as you get past this point of anxiety where you got a lot of options contracts trying to protect people from the downside, market's already corrected, peak to trough 10%, even though, returns for January, we're down kind of in that 5 to 7 range. But, there is more optimism building out there for people that are interested in increasing stock exposure in the coming months. And you've heard me from time to time talk about the fact that this is not just a U.S. phenomenon, and this is evidence of that. So this is forward earnings estimates, both for large caps up above as well as small caps. And you can see estimates are moving higher in a lot of areas. So in here we've got Europe, Latin America, Canada, and then Asia Pacific and Japan, and all of those are trending higher, even though if you look at it from 2011, all of these are benchmarked to 2011. That in some areas, they're not back up to where they were, but they're all moving directionally higher. And so, when you think about large caps, that's pretty well advertised. Small caps, particularly here in the U.S., have really taken it on the chin. And I want to draw your potential or your particular interest into that blue line, where earnings expectations have really gone higher for small caps at a time where small cap performance has really, really struggled. And I just point that out to say that there is a value opportunity in small caps, and the value differential, the price to earnings ratios are much, much more attractive there in small caps right now than they are in large caps that are also witnessing expected earnings growth. Continuing the conversation about equities, one thing that you've heard me mention quite often is that profit margins have been really, really strong for S&P 500 firms, and that's been a real source of growth in earnings that we just looked at in that prior chart. And this is two different charts that I wanted to show you. One is just net profit margins. This is after all expenses, after interest and taxes and all of that. So these are net margins. And we know in those last 2 or 3 blue bars, basically the last several quarters, that they've been really strong. And we knew that was probably going to roll over, and it does look like it is going to. Now, we're just now entering the second month of the first calendar quarter of 2022, and we expect those margins to roll over. We expect Omicron to have an impact on activity and margins and sales, so forth. But the current analyst community does expect those margins to improve as we go through the remainder of the year, which, again, when you think about people that are interested and motivated, like we saw in the last chart, on buying more stocks, that they're beginning to feel like maybe we're closer to the bottom, they look at stuff like this and they say, well, expectations for profit margins are moving higher too. It just adds more wind to to the sale that would argue in favor of positive equity performance heading into at least the middle of the year. On the right-hand side is simply quarterly Ebit margins, which is just earnings before interest and taxes. So whereas the left-hand side represents net margin after all expenses, the right-hand side represents kind of an operating profit before taxes and insurance and non-operating costs. And you can see that the trend line has been higher than the 7-year average and is expected to remain so. I had to throw a Bitcoin chart in here because I still get questions about interest in investing money in Bitcoin. And I think it's a very speculative bet. And if you look at the red line versus the black line, that's my argument. Now, Bitcoin, doesn't account for all the cryptocurrencies out there, but it is the one that's most widely reported and most widely quoted out there, and they're all quite volatile. So Bitcoin, you can see asset returns sometimes at various points have been exceptionally strong, right? Very, very strong. But at times they've been extraordinarily weak, and we've had almost a halving. Returns in Bitcoin, valuations in Bitcoin have been almost cut in half in this latest correction. And so I just caution those that are interested. Again, I'm not dissuading you from doing it. Just make sure that it is a identifiable and very finite and controlled piece of the portfolio, as opposed to the bellwether, which is really kind of represented in the red line, and to a lesser extent the gold line, which is gold. But you can see stocks over time, over this particularly short period of time, continue to move higher at a point during which Bitcoin has been extraordinarily volatile. And I'll finish on this slide, and a lot of kind of tangential conversations about this. So on the left-hand side, it's a semiconductor content in electronic systems. And you know that more of what we use on a day-to-day basis are driven by semiconductors. We know a lot of artificial intelligence is driven by semiconductor components that are embedded in the things that we use every day, particularly cars, which is why I've got the chart on the right. But we know that that's going up, and the contribution of electronics and semiconductors to car costs are going up. And we talked a lot, and we had a chart here this week of auto sales moving higher, that we know that semiconductors are really important to the automotive industry. And I also note that we've had in our own backyard a major fab announcement by Samsung that they're going to be building a lot of semiconductors in our own backyard here. We've got the Intel announcement in Ohio. You've got a lot more onshoring of potential future manufacturing here in the U.S. that I think, and we live in an age where I think a lot of industries, particularly those that are tied to semiconductors, are wanting to protect their supply chain, especially amidst the backdrop of tensions with Taiwan over Chinese potential incursion, and that there's a very high percent of semiconductors that are produced in Taiwan, and so any incursion by China would potentially disrupt the supply chain quite a bit. And so I show these to show you that semiconductors are becoming much, much more important in our daily life, particularly in cars that we drive. That will do it for this week. Hope you've enjoyed the broadcast, and on behalf of my entire team and colleagues there at BKA Wealth, hope you have a wonderful week, safe week, and we'll talk to you again soon. Take care. Bye-bye.